Thanks so much for tuning into this earnings conversation with Brigade Enterprises. They came out with numbers which, if you look at the reported numbers, would show well, a consolidated PAT, yes, but a consolidated revenue from operations lower by about 10%, and consolidated EBITDA down about 1.6%, so flattish. But if you look at it in slight more detail, then the sales value, sales volumes have looked very impressive relative to Q4 FY23. I think it also marks completion of a successful FY23 for them. And the questions, of course, would be about, on the back of such a year, how is the outlook for the next few years looking like? Pavitra Shankar, she is MD of Brigade Enterprises, joins us right now on the show. Pavitra, great having you. Thank you so much for taking the time out. And you would be happy with the kind of performance that has come in, both in terms of the sales volumes and the sales value, I presume.
Yes, actually, we're very happy. Well, first of all, hi, Neerav, and nice to meet you.
Likewise.
We are very happy with the results. As you mentioned, what shows up as revenue can be a little misleading in terms of the performance that's happening on the ground today. I'll just explain that. So predominantly, our business, is about 60 to 70% residential, given, the point of time when you look at it. This year, hospitality has done extremely well, so has contributed a lot to the overall top line revenue. Leasing portfolio has also continued to do well. On the residential front, what we report as revenues is per the accounting standards, Ind AS 115. So what we can count as revenues when the projects that have already been sold get completed, registered, and handed over to our customers. So this is basically reflective of the kind of sales volumes we had maybe 2 to 3 years ago, and these projects coming up for registration and handover. So in this year, what we've seen on the ground in terms of operations, which is a leading indicator of future revenue to come, we've done 6.3 million square feet of sales, which is over a 35% increase over last year. And we continue to see a very strong momentum for the real estate segment. So we are very happy with the results, and I think the team has done a fantastic job.
Yeah, as you said, hospitality too, it may have given a bump up, but I would reckon for you, there is a lot more to go, because if I'm not wrong, the occupancy currently is still at about 69% versus 62% pre-COVID. So there is still some legs to go there. And I'll come to that in a moment, Pavitra. But first, the real estate segment, which is the mother segment, right? Now, most people that I speak to talk to me about how Bangalore, some pockets of South, are the places where you go in for real estate investing, because the demand is strong out there. And the taxable income of consumers out there is increasing quite strongly. My question to you is, gauging by the kind of supply that is there in that region, as well as the portfolio that you have at hand, how confident are you of the kind of growth that you can put in, and the certainty of demand, if you will, for portfolio in that region?
Yeah, so southern markets, Bangalore, Chennai, Hyderabad, are mainly driven by the IT sector. There is a lot of talk about what's happening in the IT sector, but also I would say it's more of a normalization in terms of the kind of hiring that the companies are going through, maybe the kind of offers people were getting in the sector 2 to 3, or even just last year. All that is just sort of settling down and stabilizing, in our opinion. So because we haven't seen that impact, whether it comes to the demand for completed projects under construction or even new launches. And I would say the new launches is when you get a sense of the customer's willingness to take a bet, to buy a project, or to buy a unit in a project that might get delivered 3.5 to 4 years from now. The number of footfalls coming on ground, the number of responses to digital marketing and those kind of inquiries, that has only been zooming up. So from that perspective, we don't see, a real change in the demand. Yeah. So on the other aspect of it, on the residential side, we also see a supply coming in from good developers, but also because of the launch volume being taken up, by the demand from customers, a lot of that inventory doesn't really stay in the market. So I think today the name of the game is to get for us to acquire new lands, to convert those lands into actual launch pipeline after having the design and approval cycle done. And then we do see continued demand for that inventory as soon as it comes into the market.
Have land prices in the areas that you are in gone up substantially, and is it now more a case of tactically choosing parcels of land that might come in at a good price, or is it still stable, the uptick in pricing?
And I think pricing for land has gone up a little bit, definitely because it's not just about the availability of land. It's how much that land can actually be used for development. The quality of the title is extremely important. So a lot of times we are willing to pay for lands that have good and clean title. I think that is one of the biggest factors for us, because having that ensures that the brand value is also upheld over the course of the years. Like, you shouldn't have issues with your title or any kind of approval issues, once you've handed over the project as well. So there is land available, but the question is how clean is the title and how marketable is that property. We pay a lot of attention to access, visibility, and other factors like that. So we are quite choosy when it comes to picking our lands.
Interesting. Mr. Farazak of Prestige was telling us the other day that he would wish that title insurance would come into play into India the way it is in the West. But so tell me, is therefore the cost of procurement of land, one would say, is going up for you?
It is going up slightly, but I would say on the flip side, the value of doing business, especially since we do a number of joint development deals, the value of doing business with us has its merits, and definitely that is part of the consideration when the landowner comes to somebody like Brigade. Even in an outright transaction where we're purchasing, the seller does want certainty of transaction closure. And to deal with somebody like Brigade on the other side of the table is crucial for them, because they know we have access to the funds. There is a trust factor there. And that all helps towards the closure of the deal. So that does help us in some ways to have access to lands at better rates than others.
Mm-hmm. So highest ever pre-sales, meeting guidance comfortably and beating it, 36-37% if I'm not wrong, or thereabouts, mid-30s on most counts. On the real estate segment, you couldn't have had complaints. The question is, on an ever-increasing base, is it possible to reenact that kind of performance for the next year? We'll take it year after year. I'm sure you have a longer term strategy of CAGR, but I'm just trying to get to FY24 right now.
Yeah, as you said, we do look at the CAGR of the portfolio. It is very difficult to sort of promise or underwrite these kind of growth numbers. Even for us over the last couple of years, we have shown growth, but it's not easy to continue to show 30% growth year over year. It's highly a function, again, as we just talked about, of good available lands and converting those into launch pipeline and then launching it. So I would say for us, we have a good pipeline of projects coming up. They stagger towards the second half of the year, so it might be a kind of repeat where we see good movement in the first half, but actually most of the growth may come towards the second. So that's what we're sort of looking at for FY24. That said, we do have a land bank of that can give us over 40 million square feet of developable area, and that's something that we have visibility on and will come into our launch pipeline over the course of anywhere between the next 2 to 5 years.
So therefore FY24, would you believe that is relatively easy to kind of predict? I'm not asking for you to tell me an exact number, and nor am I asking for a 35% uptick guidance, but I'm just trying to understand, do you expect it to be a healthy year based on all that you have planned for and maybe done some launches and looking at the pre-sales that are there as things stand?
Yeah, so we launched around 5.5 million square feet last year. A lot of that got sold, but of course, all those projects won't get completely sold out in a quarter. We're also looking at not just managing sales velocity, but also, pricing improvement and improving our real estate. So that is why we want to take the time to sell some of the inventory as well. So keeping that in mind, we do see good results for Q1, Q2. But of course, like, the launches will contribute heavier to the overall pipeline, and that is where Some of that could come into Q4, but some of that may get pushed into Q1, which is why I have reservations sort of committing to what kind of overall performance it would be for FY24.
Understandable. A couple of other questions. One is on the hospitality portfolio. The occupancy, as I said, has inched up higher than pre-COVID as well, but still 69%. Now, what is a healthy number according to you? Where is it that the portfolio stands versus where it could be, say, end FY24 or FY25? And how is the momentum in that business? Because everybody talks about, I mean, the Cricket World Cup, G20 presidency, so on and so forth, and the number of investments that are being made in the regions that you operate in, on the foreign portfolio side as well, would all probably lead to fairly buoyant beliefs about that business?
Yeah, I think the hotel sector has been through so much over the last couple of years. There hasn't really been too much supply being added to the pipeline, or even coming into operations, which is why we've seen good performance across the entire country, and of course in our portfolio. So while you're looking at an average occupancy of 69%, some of our hotels are doing better than that. Some of them that have come on board, fairly in the recent past, or in particular markets, they're not doing as well as we would like. So that is where we would try to be pushing occupancy while looking at the average room rental as well. So yeah, I do think there will be growth in the overall portfolio. This year we did around just under 400 crores of revenue. I think we'll be seeing an increase in that number. As you said, things like G20, the Cricket World Cup, all of that will improve the overall occupancy and room rates. But what I also want to underscore is that travel is back. Domestic travel has been back for a while, but corporate travel, international and foreign travel, whether it is for work or for tourism, all of that is increasing. We're seeing that traffic in the airports across the country. And I think that is one major factor which is going to continue to support the hotel industry. The government has also spent a lot and indicated that they would be supporting the hotel sector by building out infrastructure projects as well. So all of that helps the general optimism for the sector.
Yeah, may the good times last. I have one question, and we've spoken about this once in the past as well, and which is some ruling change that you are hoping for or trying to get on the SEZ side, which might unlock some value for you. Now, can you tell us what this is, or although we have spoken about it in the past, and where is it that you are on those permits, if at all?
Yeah, so basically we had, two projects get delivered, towards the end of the sunset clause of the SEZ regulation.
Mhm.
And basically back in January, it was tabled in Parliament to introduce something called a Desh Bill, which would basically enable domestic occupiers to take advantage of these tax benefits that were allowed under the SEZ regulation. It was tabled in January, but I think this discussion has been going on for over a year or more than that. I'm not sure I don't think we're super optimistic that this will actually come to fruition. I do hope that it does. But in the meantime, our leasing team has still seen some traction for the vacancy that we have in our portfolio. We have around 1.2 million square feet still to be leased. But in both these two developments where we were having, some slowness, mainly because they're SEZ properties, our existing tenants also may be looking to increase the space there. These are both very high quality developments. They would fulfill ESG criteria, which is important for a lot of the tenants out there today. So it is a little harder than maybe leasing non-SEZ space, but I think we're still confident that we would be able to lease up the space, and then we would see it translate into cash flows in the coming years.
Okay, sorry. This will be my final question. Is there a target for the lease portfolio of what is the annual rental income that you might be looking at some point of time? Is there a target you're working towards?
Not necessarily a target, but we do have visibility because today the overall office retail, and we do have a property management of facilities portfolio. All of that is at around a 750 crores number in terms of revenue. We see that increasing to around 850 crores in the next year, and based on continued lease up of the vacancy and the rent-free periods going away and all of that, it could be up to maybe 1100 crores by FY26. So that's kind of the trend that we are aiming to see. We also have another project called Brigade Twin Towers. It's around 1.3 million square feet, where it's still under construction. We will start considering leasing that fairly soon, and then we will be looking at adding that as well to the overall portfolio.
Fascinating. I believe the real estate upcycle is well and truly underway. And Pavitra, I would presume that you would believe that we are in the midst of it, not at the tail end of it.
Definitely. On the residential side, for sure, I think the cycle, or the sector was due for an upcycle. I know there are a lot of headwinds as well, but I think the groundswell for demand for real estate is still there. The overhang from the pandemic, where people still really value, better spaces to live in, better amenities, larger spaces, suiting a hybrid working lifestyle. All of those factors are really pushing people to consider upgrading their living space. So I think on that front, we do see continued demand for it. Of course, everything is a cycle. I can only hope that we see this cycle extend beyond our expectations.
Cross fingers for that. But thank you so much for taking the time out and speaking with us. Lovely talking to you as always, and see you in the next quarter.
Great. Thanks so much.
Thank you. The pleasure was ours, and viewers, thanks for tuning in.